Between 1982 and 1990, more than 40 countries, primarily in Latin America, but also in Africa, Asia, and Eastern Europe, were engulfed in the worst international debt crisis in history.
Suddenly you had all these Middle Eastern countries that had an awful lot of money, and everybody began to rush around to find somewhere where these countries could invest.
And they said, well, Walter Wriston of Citibank in New York said, no country can go broke. Well, we all know that countries can go broke. And so it was a very severe crisis.
Banks were pouring money into Mexico without understanding the Mexican balance sheet, which was very overloaded.
That was their attitude, that they could continue to lend money, and because there never had been a country go bust or stop making its payment, that it would never happen.
It became obvious quite quickly that the entire banking system of the world had fallen into a trap here, and they hadn't secured themselves properly. It's the classic banking issue. If people run out of money, you have a problem with your assets because you can't unload your assets at the same pace as you can your liabilities, and the liabilities went south.
You know, there were a fair number of African countries, and those still needed to be resolved, and clearly there had to be write-offs.
The sovereign debt crisis, or LDC, of the 1980s led to a lost decade for many Latin American countries that could not service their foreign debt. But how did it all start?
In the early 70s, there was something called the Yom Kippur War in the Middle East.
It is an all-out war. That's how Israeli Defense Minister Moshe Dayan describes an invasion of the Golan Heights and the east bank of the Suez by Syria and Egypt.
And to punish Western support of the Israelis, the Arab states dramatically increased the price of oil. And so suddenly, these really undeveloped countries in the Middle East were awash in cash, which they couldn't use, was surplus. So the International Monetary Fund and other agencies created what became petrodollars to circulate this money, and it looked like something made in heaven because that money could be taken from where it was surplus and applied in underdeveloped countries to build schools and hospitals, educate the people, etc. Well, it didn't quite work out that way. A lot of the undeveloped countries took this money, invested in their military, and indeed, some of the money, I gather, went into Swiss bank accounts for individuals. When the inevitable happened and the price of oil declined, there was a default, and the first default was Mexico.
With the significant influence of the U.S. government, large U.S. money-centered banks were willing intermediaries between the two groups, providing the exporting countries with a safe, liquid place for their funds, and then lending those funds to Latin America. This led to a dramatic increase in Latin American borrowing from U.S. commercial banks and other creditors during the 1970s. At the end of 1970, the total outstanding debt from all sources was a modest $29 billion. However, by the end of 1978, this number had surged to a significant $159 billion. By 1982, the debt level had reached a staggering $327 billion.
The price of oil quadrupled, went from $3 a barrel to $12 a barrel, and suddenly you had all these Middle Eastern countries that had an awful lot of money, and everybody began to rush around to find somewhere where these countries could invest.
Classic case of low interest rates going much higher in 1980, and commodity prices falling, and countries borrowing in the U.S. dollar currency instead of their own. And then Mexico was the first to declare a moratorium.
The banks started to borrow very heavily from the petrodollar world. They had these huge flows of money arising from the escalating price of oil, and they had to place it somewhere. So they started to make huge loans without research at all. I mean, the banks were pouring money into Mexico without understanding the Mexican balance sheet, which was very overloaded. They were all at fault, and it was simply awful, in my opinion, that they weren't regulated.
The potential risk of debt in Latin America and other less developed countries didn't go unnoticed. In 1977, during a speech at Columbia University, then Fed Chairman Arthur Burns criticized commercial banks for assuming excessive risk in their third world lending. Still, by 1982, the large U.S. money-centered banks, as well as major banks in Canada, Japan, and other Western countries, held Latin American debt amounting to 176% of their capital. Their total LDC debt was nearly 290% of total capital.
And banks made bad deals. There became kind of this lemming-like thinking that said, we want this business, so therefore we're going to cut our number lower than everybody else so we get it. And all this money flushing through the system. And it went to countries that simply could not afford it. Mexico, Venezuela, Argentina, countries like that, they'd gone bust.
Not only do I remember it, I was a director of one of our large banks every day of the 1980s. And I do remember it. I don't want to claim any prophetic status for myself, but I remember in one of my early meetings as a board of directors of the Bank of Commerce, there was something there, a loan of $30 million to, and I quote, His Excellency, the ruler of Dubai. And so I said, well, what security is there for this? And they said, well, it's country risk. I said, yeah, but it's not a loan to a country. It's a loan to an individual. They said, well, it's the same thing in Dubai. I think, what happens if he's on a skiing holiday in Switzerland and his brother throws him out and said, he's out, I'm in, and we're repudiating his debts? Then where are we? Well, we'd have to see what security he had personally. I mean, meaning you write it off. That's what it means. It's a bad, what do they call it? A bad loan experience. It reminded me of the British biscuit, the chocolate taste explosion. It's the chocolate taste explosion that lures you. And now it didn't happen with Dubai, but it did happen with Iran. I mean, the bank had a lot of loans to His Imperial Majesty the Shah that couldn't be collected after the change in regime there.
By the early months of 1982, the danger flags were flying.
Mexico and then successive other countries admitted that they couldn't afford to both service their debts and keep their populations happy at the same time.
Officials from more than 100 of the world's largest banks emerged today from the New York Federal Reserve Bank after meeting to discuss the money Mexico owes those banks, about $80 billion. The problem is that half of it comes due within the next year, and Mexico can't pay it.
We have been facing a liquidity problem, a cash problem.
It starts out as a financial matter, but if the country's currency is reduced in value, that means that you'll have a lot of unrest in the country because people just won't have enough to eat.
By late in the decade, the industrialized world's priority was lowering inflation, which led to a tightening of monetary policy in the United States and Europe. Nominal interest rates rose globally, and in 1981, the world economy entered a recession. At the same time, commercial banks began to shorten repayment periods and charge higher interest rates for loans. Latin American countries soon found their debt burdens unsustainable.
The Canadian banks certainly had their moments when they kind of went overboard on lending to less developed countries and got caught up in the general conflagration, I'll call it, when at that point, that was when Mexico said it couldn't pay, and then the thing spread like wildfire. It was announced to everybody at the IMF meetings, IMF World Bank meetings, I guess they are, but the IMF meetings basically, that Mexico had run out of money.
So the banks were moving into the Euro businesses in the 70s, And they started to take on a lot of developing country risk through that period. And in September of 1982, Canada hosted the IMF meetings. And to my great delight, I was invited because the Canadian banks were hosting the meetings. And I will never forget the dinner that evening, which was absolutely the same day that Mexico announced they were going to default on their LDC loan. And that was totally the beginning of the crisis, and it happened so quickly. And then it was like a deck of cards after that, or a set of dominoes.
The spark for the crisis occurred in 1982, when Mexican Finance Minister Jesus Silva Herzog informed the Federal Reserve Chairman, the U.S. Treasury Secretary, and the International Monetary Fund Managing Director that Mexico would no longer be able to service its debt, which at that point totaled $80 billion.
I told them a very old Mexican expression. We owe you money, I recognize it, but I don't have any money to pay you back. It was the detonation of the debt crisis.
Other countries quickly followed suit. Ultimately, 16 Latin American countries rescheduled their debts, with 11 other countries in different parts of the world.
Inflation shot up nearly 100% in 1982 alone. The peso collapsed to 1/5 of its former value, and unemployment climbed to 12%, with another 30% able to find only part-time work.
These were called sovereign loans when they went to a specific country. So even the name sovereign loan somehow has this great, glorious sound to it, as if it'll certainly stand the test of time. And I mean, I can remember meeting a banker. He literally said to me, "Don't you think Brazil is worth $80 billion? Of course, I had no idea, but that was their attitude, that they could continue to lend money, and because there never had been a country go bust or stop making its payment, that it would never happen.
And the same was true for their loans elsewhere. They were splashing out all this money into less developed countries without the resources. They didn't do enough research on the capacity for repayment, and they took huge losses for that. In my opinion, that was a huge failure by the regulatory system. In my opinion, huge. Well, they saw what was happening, but they didn't do anything. It was just, in my opinion, it was neglect.
They just threw out the book on evaluating risk. I've asked former bank auditors about this, and they said, well, Walter Wriston of Citibank in New York said no country can go broke. Well, we all know that countries can go broke. And so it was a very severe crisis.
As the last shovelfuls of money were going into these countries, before anybody realized they shouldn't have put anywhere near that much in, there was a lot of corruption. There was a lot of officials, higher-up officials and military people. I mean, the money was going into those countries, and the next day it'd be off into a Swiss bank account. So not only was it not available for development, it wasn't available to repay either. So that's when the banks began to say, well, look, we're not going to put any more money into these countries because A, there's corruption, and B, we don't think we should be loaning them money so that they can use it to start paying us back. So some of the international institutions, the World Bank and the International Monetary Fund, began to become involved.
The fund had been very intensely involved, but you keep your mouth shut on something like this. That was the, how can I put it, the moment when Mexico said it didn't have its money, and then the banks, all of them, I guess mainly the US, but everybody, the Japanese were in big time as well, had to figure out how could they get their money out. There wasn't any. So their lines of credit they could withdraw, but it was kind of, academic is not the right word, but you know what I mean. It's the classic banking issue. If people run out of money, you have a problem with your assets because you can't unload your assets at the same pace as you can your liabilities, and the liabilities went south.
It became obvious quite quickly that the entire banking system of the world had fallen into a trap here, and they hadn't secured themselves properly. So I felt perhaps I was being too generous, and perhaps I was too ignorant to form a really sound opinion. But I thought our bank just went along with essentially all the major banks and all the advanced countries, and the whole industry made a mistake and didn't cover itself. It got carried away with government pressure to help the underdeveloped countries, and so that they just threw away their manual of criteria for lending without any security from their sponsoring governments. And it became fairly early on we were just going to have to take our lumps, and we'd all be taking them together.
One of the basic problems is when people start talking about the possibility of a crisis, people who should know what they're talking about, it becomes a crisis. You run into this problem that people who knew about the issue couldn't talk about it, not in public, because that would bring it about. And you try to fix it. So the fix was to try to get the banks together one way or another to hold off in the common interest. And they got regulatory forbearance is the term from the Fed. Up here would have been the Inspector General of Banks, that basically you're not going to get your money out, so you might as well kind of pitch in and make a cooperative effort to solve this issue. And then there's the issue, if you started writing off the claims on Mexico, etc., you have no capital left, so you declare your banks bankrupt. Well, that's not a very pleasant thing to do. Has implications all down the line. These things can become quite dramatic quite soon, but only talked about in whispered tones, in quiet rooms.
U.S. banking regulators allowed lenders to delay recognizing the full extent of the losses on LDC lending in their loan loss provision. This forbearance reflected a belief that had the losses been fully recognized, the banks would have been deemed insolvent. After several years of negotiations with the debtor countries, however, it became clear that most of the loans would not be repaid, and banks began to establish loan loss provisions for their LDC debt. The first was Citibank, which in 1987 established a $3.3 billion loss provision, more than 30% of its total LDC exposure. Other banks quickly followed Citibank's example.
Their debt held by the 8 largest American banks amounted to 250% of the bank's capital. In addition to the American banks, all the other European banks, French, Swiss, Germans, Japanese, English, they also made these loans. So it was an international problem.
Of all the crises in Canadian history, whether, even in the Depression, the crises 2008-9, which affected the world, the worst crisis for the Canadian banks was the lesser development countries. They ended up being owed billions by countries that had no capacity not to pay it back, couldn't even make the interest payments, and there were something like 34 different countries who were designated as long-suffering and unable to pay.
There was a bunch of workout discussions that happened through the 80s. There were Brady bonds that were issued to deal with the Mexican debt. It wasn't all over yet, but certainly the worst of it had passed, and the countries that still needed to be renegotiated were some of the poorer countries, some of the ones that had never gone to town on the basis of their oil economies. There were a fair number of African countries, and those still needed to be resolved, and clearly there had to be write-offs.
By 1989, it was also clear to the U.S. government that the debtor nations could not repay their loans, at least not while rekindling economic growth. Secretary of the Treasury Nicholas Brady thus proposed a plan that established permanent reductions in loan principal and existing debt servicing obligations. Between 1989 and 1984, private lenders forgave $61 billion in loans, about 1/3 of the total outstanding debt. In exchange, the 18 countries that signed on to the Brady Plan agreed to economic domestic reforms, enabling them to service their remaining debt. Still, it would be years before the scars of the 1980s began to fade.
Well, I mean, there will be uncertainty. I was rereading recently the Mexican debt crisis of 1982, I think. This is what we're talking about, when they announced they couldn't pay. And there's an IMF chapter, how that crisis evolved. A lot of people had sleepless nights. My only sleepless night came over CCB in Northland, because we had a similar issue of making sure that the lenders to the CCB, for sure, because that was the one that was in the eye of the storm at that point, didn't try to pull their money out. We wanted some kind of lifeboat, if you wish. And that meant calling all the banks and major trust companies to tell them what we were trying to do. I stayed up all night. Jerry got a few hours sleep and came in next morning. Then I went home and got some sleep. So those kind of things can happen.
In Western countries, the chief concern was the soundness and solvency of the financial system. To that end, regulators weakened regulatory standards for large banks exposed to LDC debt to prevent them from becoming insolvent. On the one hand, this regulatory forbearance was effective at forestalling panic. On the other hand, forbearance allowed large banks to avoid the consequences of their prior lending decisions. However, letting those institutions delay recognition of losses set a precedent that may have weakened market discipline and encouraged excess risk-taking in subsequent decades.
The Canadian banks were up to their ears in this. I don't think very many people are aware of this, but you always hear about banks writing things off and making provisions and saying, well, we're taking a provision this month for $1 billion to cover our losses in these LDC loans. Those amounts are all tax deductible. The bankers all got together and went to Ottawa and said, we need you to make this concession for us. Otherwise, the financial system in Canada is going to be in terrible shape. Ottawa agreed. That wouldn't have been great if you or I had a bad deal and lost $5,000 on our little startup business, or maybe you lost it at the track, any place, and went to Ottawa and said, if you don't let me deduct this from my taxes, I'm going to be in worse shape next year. So without that help from Ottawa, the banks might well have suffered, but as a result of it, the banks were writing off billions of dollars and making profits at the same time, which is great if you're a shareholder, but maybe if you're a taxpayer, you'd like to see the banks take on a bit more of their share.
But, our Canadian banking system has not been all a one-way street. In the Latin American loans, LDC, we, as a proportion of our banking assets, we were much bigger than the United States in those kind of loans. And then around the same time, we had the loans to Massey Ferguson, Dome Petroleum, and the Atlantic fishing industry. And those were really loans, disguised loans to the banks, or advances to the banks, because the gifts that were given to those companies were just used to pay off bank loans. And then they went ahead. The government looks on their responsibility as to protecting the system, what they call systemic risk and prudential regulation, which means they're happy as long as the banks are solvent. But the whole federal regulatory system has switched from protecting the consumer to protecting the lender. And you have to understand there is an inherent conflict of interest between the lender and the borrower, or the seller of securities and the buyer of securities. The seller wants to get the maximum price possible, the buyer wants to get it as cheap as possible. So there is a conflict.
Yeah, we have what comes to basically an oligopolistic system. The banks, put it this way, they're very, very strong on stability. You can't call them kind of world beaters in innovating. And I think it's probably the way Canadians like it. Whereas in the States, it's a much more kind of dog-eat-dog system. When the music is playing, you have to dance, something like that. One of the more unfortunate phrases.
Despite the many warning signs that the LDC debt level was unsustainable and banks were overexposed to that debt, market participants did not seem to recognize the problem until it erupted. The result was a crisis that required a decade of negotiations and multiple attempts at debt rescheduling to resolve, at considerable cost to the citizens of Latin America and other lesser developed countries.
You wouldn't have seen some of them grow stronger on the international stage. You wouldn't have seen millions of people lifted out of poverty over the last 20 years due to the integration of those economies with the rest of the world. I don't think we would have a World Cup in Brazil, for example. These are all signs of increasing integration of an economy into the global economy.
Painful as it was for the countries during what's often called the lost decade of the 1980s, it built a foundation for them. And the Mexicos and the Brazils and the Perus and some other countries have taken advantage.
Today, this international debt crisis serves as a cautionary tale about the risk of excessive borrowing and the need for responsible lending practices. It also highlights the importance of international cooperation and coordination in managing global economic challenges.
What we should do in terms of, you know what a bear squeeze is if people are betting against you and you squeeze them by tightening liquidity so they have to pay up high rates of interest in order to hold their bet. This tends to dissuade some people if they're not passionate about or very convinced about their short view to abandon it. And he had views about this, which he communicated to the bank, and the bank, in fact, on a couple of occasions conducted a bear squeeze, which was a combination of, it wasn't so much intervention as perhaps intervention to some degree, but also just raising interest rates rather than cutting interest rates when you have a run on the currency. Not moral suasion, it was in the pocketbook of the people who were betting against you. They say, look, the bank is serious here, you're going to have to pay up short-term interest rates in order to hold this bet. In a financial crisis, an exchange crisis, the definition to me is you get both the exchange rate moving down and interest rates moving up of their own volition, if you wish, because no one's prepared to hold, let's say, the currency, and let's call it the Canadian dollar for the sake of argument, except at higher rates of interest. They want to, because they think it's a currency which is destined to get weaker, maybe. That's the bias. So you want better interest. So the interest rates are moving up, whatever the Bank of Canada is doing, how much liquidity is pushing in at one day, 1 month or 3 months is moving up. So to put a bear squeeze on, you don't actually buy treasury bills, you sell treasury bills into the market, which reduces their price and raises the interest rate. And that's a bear squeeze. And that worked well on a couple of occasions to cut off the run. But Michael was a fan of bear squeezes.